What have you learned about weathering the storm with these pullbacks and corrections? Do you have any kind of rules of the road that you use to kind of guide you?
Okay, I'm human. Even though I've been doing this for 35 years or whatever, I am bullish at the top almost always, and I'm bearish at the bottom. But as I've aged, and experience has taught me to, close the buying window when we get wildly extended over the MAs by a historic amount, like 8% on NASDAQ over the 50-day.
Hmm.
And when my names, individual names get really extended, I like to sell deep in the money calls. Okay. Which is very different than my hedges into earnings, because on earnings, I would basically do bear put spreads. Okay.
Hmm.
Because I want the upside if something great happens. And the spread burns the volatility and time decay. Okay. So
Hmm.
anyway, that's how I hedge. And I just try to, as I've aged, I've become more temperate. I don't lever up and cowboy like I used to. I'm a little more diversified. I'm much more longer term holder, and I hedge because I'm not in a tax deferred account. Okay.
Right.
I don't want to dislodge that low cost stock.
Hmm.
So hedging is the best option for me
Yeah.
at
And
extremes.
at extremes, yeah. So one of the things that strikes me every time we talk about this, first of all, when you say the buying window is closed, it just basically means, hey, if we're going into a correction, rather than keep on digging that hole, just stop digging, right? That's number one. But you're deep in the money calls. So just real quick, how do you avoid those getting exercised? Are you going out further in time, or?
I watch them really careful.
Okay.
I mean, when you start to see the premium above the strike and the price get
Hmm.
too tight, I know I'm in danger of that, and I'll roll them out another week.
Okay.
I
How
mean,
how
like
how
when
long do you typically go for your?
I want max burn. So
Mhm.
I don't ever go out when I'm doing this strategy more than 2 weeks, and often 5 days.
Yeah.
But if you short them hypothetically on Monday, by Thursday, Friday, you are, you're on a razor's edge.
Yeah.
But if they exercise, I call my prime broker and
Mhm.
I go buy, say they hypothetically, I owe somebody a block of stock. I will call my prime broker. I'll say, look, I just bought 50,000 shares. Give them this 50 I just bought, preserve my initial cost and bill it as of.
Yeah.
Your broker will understand.
Yeah. Yeah. So again, to your point, you're really trying to protect some of your positions. Now, how do you make the decision of what gets protected and what gets, thrown overboard?
Well, I look at what has the largest total addressable market, what
Mhm.
has been my best performer, and what has the best metrics. And it's an art. It's not a science. And so in the pullback we just had, I threw off. I only had about 6 or 7 names.
Mhm.
I remained long my gold position, obviously Nvidia, Kava, Lilly, and one or two others. And everything else I threw overboard. I just blew it
Mhm.
out. And I said, well, I'll pay the tax. I'll just reduce my exposure. And then I hedged off. When you start to, I generally don't freak until the market or my names get too deeply below the 50-day. At which
Right.
point I'm like, this could be getting a lot worse. I don't know what's coming. I'm just going to throw a big hedge on. And it is an art because you, when you get these panic down moves, even early in the move, I tend to cover the short calls and see what happens. And I might even put them back on at the end of the day. There is no perfect hedge. There's no
Mhm.
perfect unwinding it. I will say that when you want to short in the money calls, you want to do it before the demise or the rollover. You want that fat premium.
Right.
Okay. Once the market starts to roll over, they implode.
Mhm.
Okay. So you want to be getting some of your hedge on before the rollover into an extension.
Mhm.
And I have to say one other thing about the level of extension we had prior to this. The McClellan oscillator was pinned to the roof, man. I mean, the signals were everywhere, but I keep a rolling history of level of extension. And if in the prior 12 months, the max extension was 8%, if it's going to go to 10, if it's going to go higher, it usually only goes a few percent higher.
Right.
But in bull markets, every progressive year, the level of extension generally increases a little bit. And I've tracked this for 20 years.
Mhm.
There are rare occasions where you have these absurd moves. And that's why when I hedge, I nearly never hedge my whole position, because what if there's a takeover? What if it has a blow off top? It's extended, but then it gets really extended. So you kind of have to look at the whole environment. This is an art, okay? And there's a ton of imperfection. I never get it right. I just try to dampen the blow.
Yeah. Yeah. You just have to be right enough. You don't have to be perfect. You just, as you said, you're trying to dampen the blow. You're protecting capital. You're trying to not dig yourself into a hole, because I think we all know the way that the math works. 8%, loss, you can recover from that fairly easily. It only requires less than a 9% gain to recover. But you let it go to 25%, now it's 33% loss, it's 50%. Now you need 100% just to get back to even. So again, it gets back to the, if you're in a hole, stop digging.
You have to circle the wagons around your elite. I believe all my names are elite, but I want the elite of the elite to hang on. And my maxim is this: when I started as a broker and as a hedge fund manager, subsequently, almost every single broker I started with is out of the business, and almost every hedge fund manager who started, they're all out because they, at one moment, did not live to fight another day, and they blew up. I think the reason I've stayed in business is because I do take too much of a drawdown off the top, but I'm always going to stay in business, I think, because I just cut all my loss. I'm so diligent about that. 3, 5, 7, sell a third of my position from my cost. And then the guardrail, too deeply below the 50 is either a big trim, or too deeply is a major hedge, like major delta neutral. Okay. Risk management is cutting losses, but it's position size. Price will hurt you, but size will kill you. It will blow you out. And I learned that from a really smart guy who lived about 4 houses down from me. He was a really big trader, like giant.